Hey guys, in this video we're going to be covering property taxes in Texas. My name is Aaron White. I'm a realtor here in Katy, Texas, and we're going to be talking to both buyers and also to sellers on what you should expect at the closing table for property taxes, who ends up paying what and when, where does that money go, and what might you need to pay after the sale even. Yes, both buyers and sellers as it relates to property taxes. That's what we're going to dive into today. All right, so when we're talking about property taxes in Texas, we need to make sure that first of all, we're on the same page in regards to timeline. How do the timeline of taxes actually work in Texas? Because you're gonna get letters all throughout the year for different things, bills and appraised value, assessed value, so on and so forth. So let's recap that first of all. Quickly, January 1st, you're gonna be paying the taxes for the previous year. It's paid in arrears, right? And then second of all, we're gonna get into May. That's when they send out the assessments for the property and you have the option to protest the assessment. If you wanna watch how to do that, there's another video on how to protest your own assessments. All right, then in September, the county will establish and all the different jurisdictions will establish their budgets for the year. And in October, they mail out the new bills for the property taxes that will be paid January 1st of the following year. Because property taxes are paid in arrears, it often gets a bit confusing for both buyers and or sellers as to who owes what when, and values change. So what happens if those values change? And that's exactly what we're gonna get into in this video. All right, so let's start off with sellers. If you are a seller and you're selling a property in a calendar year, let's just say this year is 2025 for reference. So let's just say you sell this property in June 30th to make a simple number for splitting that number in even, right? Because taxes are paid in arrears, your property taxes for the time that you own that property up until June will be paid in January 1st of the following year. In this case, it's 2026 that will be paid. Well, the new buyer is gonna end up having to pay those taxes and it's not fair for them to pay all of those taxes. So what will happen is that at the closing table, the title company will prorate these property taxes and they will take them out of your proceeds and give them as a credit to the buyer. So for sellers, let's talk about an example. Let's just say hypothetically that your tax bill for a year is $4,000. It's fairly low for Houston, Texas, but bear with me, simple math is good things. All right, well, because we're selling this house on June 30th and it happens to fall right in the middle, then that means that the seller would need to cough up $2,000 of their net proceeds that would go as a credit to the buyer, because in the end, the buyer will pay the taxes January 1st when that bill is due. So that comes as a credit to the buyer and that's received. Now we're gonna jump into the buyer and understand some of the driving factors for the buyer. Just like the seller, you're gonna have $2,000 in property taxes to buy, but that's not due really until January 1st. So you don't necessarily have to bring that to the table if you're buying this house cash. Now, if you're using a lender, it's important to understand that typically a lender is going to require you to put about 3 to 6 months of property taxes in an escrow account at the closing table. So you might actually need to bring the $2,000 in this scenario to the closing table in order to fund your escrow account. The idea with an escrow account is that it has to have some minimal amount of money in there in case the values are not perfect at the end of the year. So there's a buffer that they can draw from and pay those taxes that following year. And then each month you're paying part of your escrow payment that will continue to fill up that bucket and then automatically pay your taxes for you come January 1st. Okay, now for buyers, we're gonna talk about two things that create a significant amount of confusion I see with clients from a regular day-to-day basis if this isn't explained carefully to them when they are buying a house. And there's really two scenarios. One of them, the first one, is mainly really important for new construction purchases, but it can also be important if you're buying a house and the value of your purchase price is significantly higher than the current tax assessed value is. If there's a big gap there, you need to be aware that you may face a surprise come next year when you start getting payments from your mortgage. All right, so in this scenario, let's just pretend you buy a house. That house has, at the time of sale, it's a brand new construction. So the tax assessment of that value, because we're halfway through this year, is saying, well, there was no structure there. Therefore, your property taxes for the whole year is $2,000, right? Not very big bill, right? And so your lender says at closing, you need to put 3 months of this in an escrow account. Great, that's only $500 at closing. You're super excited. You move into this house and you paid very little at closing. That's awesome, right? Well, fast forward and come January 1st of the next year, they say, hey, your property tax value is actually $15,000 per year, right? All right, so now we have a value of $15,000. All right, so obviously $15,000 is very different than $2,000, and your monthly mortgage payment is gonna go up. So by default, you're gonna have some sticker shock when that happens. However, if you purchase that home before that property was assessed in value, right? You are still going to be paying the $2,000 in property taxes because that's how that breaks down. However, the county is going to say, hey, the new value went from, let's just say, I don't know, 30K property to a 500K property, right? It went up there in May, but you won't get that bill for that value until here. And you're paying here for the taxes in arrears. So not only will you have the increase that the escrow will need to pay the $15,000, but, and we'll make it simple math, let's just say half a year, we're gonna need the $7,500, and this isn't perfect math, bear with me with the concept here, more than anything. You need to have the $7,500 plus the $15K, plus your escrow account requires 3 months of the annual number, right, to be in there. So they want to see an additional $3,750 in that account, totaling over $26,000 now for that next year. Needs to be split into 12 monthly payments, right? So the escrow account, again, will now take a jump from only paying maybe $166 a month. That value will go from just $166 a month to about $2,100 per month, right? So that value made a huge jump on your monthly payment as a buyer of a new home. And this is again because the tax assessed value at the time of purchase was significantly lower than the actual value of the purchase. Next year, the actual value of the purchase will be rectified and you'll have to owe all that money. So the way around this is to recognize that A, when I buy this house, I need to be saving up maybe the $7,500 plus the shortage of the $3,700 or $3,750 that the escrow requires me to have on hold. And next year, my monthly payment will go up to that. So that come the due time in January, I can fund that escrow account with this $10,000 and I don't have to see the crazy $2,100. I just get my regular tax bill that will come in here, that $15,000. So it's important that you understand the budget, understand that the lender estimates at closing are inaccurate when you're doing this and buying a new construction or any house that has a big difference in value from the assessed value to the purchase value. All right, so now we're gonna dive into the second thing that creates a lot of confusion. This is really important for both sellers and buyers to understand because the taxes are paid in arrears, the numbers do change. And sometimes if you have, for example, a sale right here, right before that assessed value, or maybe even right after, but the seller didn't tell you what the new assessed value is, right? Well, in January 1st, you're gonna get taxed for whatever that assessed value is. And it might be different than what it was the previous year, right? And this is common, especially if there's gaps in that assessed value, because once you sell, they may see things like your loan value and know roughly what you paid for the house, and they'll be able to adjust the value to the correct value. So you may see that at the point of sale, again, it's prorated, right? The seller pays their part and the buyer pays their part. However, this value may have gone up slightly because they got a new assessed value here in May that's being taxed for here in January. So this extra value that is above what was paid at the closing table is now falling on the buyer's tax bill, right? So what happens? Ultimately, the sale is done, so the seller technically in Texas legally has no responsibility to pay that. Now there is commonly in many title companies at the point of sale a prorated tax agreement that both the buyer and the seller will sign. And then the buyer ultimately has the responsibility of taking this to the seller and saying, hey, this is the new prorated tax, I'd like you to pay these things. And you would have to work that through an attorney if there's any kind of disputes or conflicts or disagreements on those values. But ultimately they're not paying, they're only paying really the changes in the prorated value above what they had already paid before. So that's kind of how that works. So what should your realtor be doing when it comes to property taxes in a transaction? Well, number one, your realtor should be checking that the title company did their math right. We have the closing date and we prorated the proper amount of taxes to the buyer, proper amount to the seller, and that was not calculated correctly. Second of all, you want to make sure that the title company also looks at what exemptions were on the property previously. So for example, if they had homestead exemption and maybe a senior exemption, reducing that property tax, and the new buyer who's an investor is not going to have either of those, we want to make sure that the proper amount of taxes are prorated for that calendar year and done correctly. Of course, this brings me to another reminder for buyers. If you are buying and going to be moving into a property, make sure you file for that homestead tax exemption. It doesn't take a lot of work. You're going to get a lot of mailers in the mail afterwards saying, pay me XYZ to file this. I would suggest just go into the county website, fill out the form, send it in yourself, and it'll get you that same exemption. You don't really need to pay somebody to do that. If you have any questions on your tax bill, what can be expected at buyer closing, make sure you reach out to us, give us a call, and we'll walk you through the proper process to make sure that you have at least the proper plan in place. We'll see you at the closing table.